Welcome to my channel. Today I want to tell you and explain to you why the price of a stock does not matter. This is something I think a lot of newer investors make a mistake on. I did it myself, and I think this is going to be a very educational video that you should share with those around you that are new to investing or maybe have been investing for a while and it's just a good refresher. Now, before we get started, as promised, let's look at my portfolio performance. It has gone down. We're down 4.85%. That's $2,600 in the red. Of course, our market, or the stock market's going down. There's a lot going on, and I think we're going to be in for a rough road for at least another couple months. I think the Fed is going to be increasing rates throughout the year and won't decrease until next year. And I don't think that's something that got priced in. I think they expected prices to start going down, those rate cuts. Regardless, I am in this for the long term, so I like when there's a bargain in the market and I will be buying. Now let's get to this video. We're gonna look at two ETFs, and I just wanna say, I had a friend reach out to me recently and she's new to investing and I love her drive for this. She wants to learn, and that's the way you do things. So she'll reach out to me and say, what do you think of this? And she does her background research and it's just great. And she presented this question to me. She compared these two ETFs, and I think with many investors, they lean towards the more inexpensive one. In other words, the one that is a lower price per share. But I'm going to explain to you now why you should not consider the price of the stock per share and instead look at many other factors. So let's get right into this. The two ETFs we're going to compare are OneQ, O-N-E-Q, which is a NASDAQ ETF, so that's a tech-heavy ETF, and then SPY, S-P-Y, which is the S&P 500 ETF, so the top 500 companies in the market. Now let's look at their price per share. The first thing you'll notice is OneQ is $45.40, where SPY is $398.92. So you have a big difference there. SPY is $400, OneQ is $45. Right here, a lot of new investors and probably other investors are going to gear their eyes towards that $45. But I think our whole lives, we've been trained to look for a bargain. And you click an example, if we go to Walmart versus Whole Foods, they might have similar products or even the same products, but Walmart's will be cheaper. And there is an example where, yes, you want to buy the cheaper thing, but when it comes to stocks, you have to erase that way of thinking. And I know we've been trained that way our whole lives, but with this, you need to ignore the stock price, and I'm going to explain why. So let's look at the first thing, especially with ETFs, because stocks won't have this, but ETFs have a net expense ratio. Now, OneQ's is 0.21%, where SPY's is 0.09%. So already, OneQ charges almost 2.5 times than what SPY does. Now, a net expense ratio is what the funds will charge because these are passively and actively managed. These two, I think, are passively. So they are going to charge a fee to kind of recoup the expenses of running and managing these funds. And this isn't like a bill you get at the end of the year or something. They just take the balance off your net asset value, which you'll see at the end of my example. It'll make very clear what that net expense ratio does to your stock. So the net expense ratio, we can already see OneQ charges more. That's one thing I don't think a lot of people look at. They stop at that price per share and just buy the cheaper one. But let's take it out even more. These both pay dividends, and a lot of stocks do as well, which is returning value to the shareholders, profits. And so right now, OneQ has a dividend yield of 0.89%, where SPY has a yield of 1.59%. So you're getting a higher dividend yield with SPY, which means they're going to be paying you more in dividends. And how all funds and stocks, they pay a certain dollar amount per share you own. So with OneQ, you will get 39 cents per year per share you own, where SPY you'll get $6.32 per share you own each year. So that's the amount you will get. Now, a lot of funds and stocks will pay quarterly, so they'll divide this up in quarterly payments or monthly or biannual payments. So this is another reason why you have to look deep down, because already OneQ has a higher expense ratio and OneQ also has the lower dividend that they're paying out. Now, in this example, we're going to assume you buy $10 of each fund. And the good thing these days is you can buy partial shares. And we're also going to assume that the price per share of each one stays exactly the same price for a full year. Let's just use that to make things easier. So your ownership of $10 of 1Q, you're going to own 22.03% of a share of 1Q. And with $10 for SPY, you're going to own 2.51% of one share of SPY. So the yearly expenses that you're going to pay, because remember they both charge a net expense ratio, for 1Q, you're going to pay on your $10 0.021 cents, where SPY you'll pay 0.009 cents on that $10 after 1 year. So after that year, if nothing else happens, so no dividend is paid and the stock price stays the same, you will see your balance at the end of that year with 1Q go from $10 to $9.97, 98 cents. And with SPY, you'll see it go from $10 to $9.99. Already, you're keeping more of your money with SPY than with 1Q. And this is the example I want to give you with the net expense ratio, is if this, you buy in, and if the price does not change, you will see that $10 at the end of the year show a balance of $9.97 or 98 cents, and then with SPY it will go down to $9.99. So that expense ratio chips away year after year. But the thing is, the hope is with the ETF is that this will appreciate in value, so that expense ratio really won't make a huge difference. But it does, when it comes to a high expense ratio, it can really eat at the profits and the gains that you hold in that ETF. And there's many studies out there you can look at, but the higher the expense ratio with the more money you put into and invest in with it, it really makes a big difference in your profits and gains. So I always like to go with the lower expense ratio. Usually, of course, there's some examples where I think you can choose the higher expense ratio if there's some other benefits. Now, there's that dividend, of course, that each ETF is paying. So the yearly dividend that you'll get paid with 1Q based on your 22.03% ownership is 9 cents. You'll get paid 9 cents per year, where SPY you'll get paid 16 cents per year. That's because they'll pay you still a dividend based on the percentage of ownership of that share you hold. So in other words, if you owned a full share of 1Q, you'd get that 39 cents. If you owned one share of SPY, you'd get that $6.32, but they take in proportion to what your ownership actually is, which again, you own 22.03% of 1Q and 2.51% of SPY. So at the very end, when you take into account the expense ratio and the dividend that you're getting paid, if the stock price does not change, your balance will be at the end of the day, at the end of that 1 year holding with 1Q, $10 and about 6 cents, and with SPY it'll be $10 and about 15 cents. Already right there, you can see if you put $10, the same amount into each fund, you're already making more money with SPY. And that is the lesson I am trying to explain to you guys, is the stock price doesn't matter. It's everything else that matters. And a lot of people like to focus on the stock price, and there are maybe some small things that you can argue, but in the big picture, I think it's one of the least things you should pay attention to. So I want to go over a few other things. Let's look at the top 10 companies each ETF holds. Now the NASDAQ ETF 1Q is tech heavy, so you'll see here they have all tech stocks. Whereas SPY, they hold the top 500 companies, so you're going to get stocks from all sectors, but right now they are heavy on the tech side, but they also have stocks like ExxonMobil, United Health Group, so you're getting some energy and healthcare play. And if you look at the rest of the holdings in both these ETFs, SPY will have holdings in pretty much all the different sectors of the market. So I think right there, SPY is the better ETF in my opinion, because it's going to be more diversified. Where 1Q, you're really betting on the tech sector doing extremely well and beating the top 500 companies, which at the end of the day is a decision you have to make. But I prefer SPY. It's more diversified. I think it's a safer holding than 1Q. And also 1Q has that higher expense ratio and that lower dividend. And long-term, the expense ratio will eat at your gains compared to a low expense ratio. Now let's take into account the performance of these funds, these ETFs. So if we look at the past 5 years, with SPY, they're up 40.74%, whereas 1Q is up 49.34%. So 1Q over the last 5 years has done better, just shy of 9%. But if you factor in how much that you have invested, the expense ratio that's higher than SPY's and the dividend yield that is lower than SPY's, I bet you it probably could come to, almost even, or maybe you're not doing as good as SPY. It just depends on the amount of capital you have invested. But let's take this out to just 1 year. Let's say you're a newer investor and you invested in both these 1 year ago. 1Q is down 12.77%, where SPY is down just 8.13%. So right there you can see that the tech-heavy ETF is a little more volatile, where SPY is holding up a lot better in these volatile times. At the end of the day, I really think that it comes down to your wants. Do you think the tech sector will do better? Are you okay with that higher expense ratio because you factor in that it'll perform much better than SPY? Are you okay with the lower dividend? There's so much to factor in, where the price per share is not the thing you should be looking at. It's the valuation of a stock. It's the metrics. It's the key ratios, such as the expense ratio, the dividend yield. Really, everything else but the price per share is what you should be looking at. So how I value a stock is, yes, I look at the expense ratio. I look at the dividend that it pays out, maybe the history of that dividend. I also look at things like this metrics chart that I've put together. Now, I share this with a lot of my videos where I do deep dives into individual companies, but I look at the financials, such as the PE ratio, the earnings, the revenue, the cash flow, the margins, the returns, the debt that these companies hold. There's a lot you have to look at besides just that stock price. And if you focus on everything else, you are going to find the quality companies and the good values out there in the market. The other thing that I consider highly to value a company, whether it's of good quality and a good valuation, is this quality checklist that I put together. And I've been using this since beginning of the year. I created this and I stick with this to buy my stocks. I recently just did a video on my new stock, SPGI, and it checked all the checklist items for me. And I was like, yes, this is a quality company. I think it's at a good valuation. Long term, this is going to make me lots of money because I think that it fits with my strategy and this checklist that I put forth. So does a company have good financials? Does it have a good management team? Does it have brand recognition? Does it have products and services that create repeat customers and customer dependency? And so does it have a good ecosystem? Does it have a good moat? Does it have that competitive advantage? Is it hard to disrupt or replicate? And is it at a good valuation? Where is it sitting now compared to its historical averages based on, for example, the many things we looked at with that metrics chart, the different financial ratios and measurements? This is how you should be looking at companies, at ETFs that you buy, not the stock price. I think that is something you should just kind of ignore because it's not going to do you any good. As you saw, as we went through this example, SPY is the better option when it comes to if the stock price stayed the same, $10 in SPY versus 1Q makes you more money. But a lot of people just look at that cheaper price per share and they think, oh, that's a better deal. But it is not when you look at it with this example. Another thing I just want to mention before I end this video is Amazon and Apple. Amazon, last year was about $3,000 per share. Apple was $120 per share, let's say. And a lot of people look at Amazon like that is an expensive stock, where Apple's cheap. But if you look at the market value of these two, Apple was more than double the market value of Amazon. So that's what Apple was valued at versus Amazon, and is more than double. Because there's something called stock splits, which Amazon just did. They did a 20-for-1 stock split. So if you owned 1 share of Amazon, after they did their stock split, you own 20 shares. They divided that into 20. So now Amazon sits at about $100 per share. But there's so much to consider, and also the amount of shares outstanding, et cetera, et cetera. So I think being a part of a channel like this is going to really help you learn about the other things you should be looking at, what a quality company is, what I deem a quality company is, because everyone has different opinions, which I respect. But I'm here to tell you with this video, Don't focus on the price of the stock. Focus on the valuation. Focus on, is this a quality company? Look at the other things besides the stock price, because as we saw, that did no good if you bought into 1Q versus SPY just based on that stock price alone. You need to look at everything else and consider it. So I think this is a good video to share with new investors or anybody. I really hope this gains traction because I think it's very important, an important lesson to learn, because I was guilty of this. For example, I was buying Ford because it was $8 a share versus when I probably should have been buying Apple or Microsoft at the time, or other very high quality companies that didn't have the cyclicality of Ford and had better financials and were higher quality when it came to products and services and all that other stuff. I ended up selling out of Ford, luckily at a small gain. But looking back now, I would have not have made good money with Ford compared to a lot of my other stocks. And so I think there's just so many examples of why you don't want to focus on the stock price. So let me know what you thought of this video, if you have any objections to it, or if you agree and this made sense. And I really do appreciate all of you that are subscribed to my channel. And if you're not, be sure to subscribe. Check me out. I provide good quality, regular content, and I'm growing, I'm expanding, and I'm improving always, because we always have something to learn. And so with that said, I hope you guys have a great day, and we'll see you next time on Mark Arnold's Finance.